We're all about education at American Fidelity Mortgage Services. We're really not about sales from the standpoint of if somebody contacts us, they really only are going to get free educational materials, maybe a couple follow-up phone calls, but we're not going to bug you to death. And we do some of the information we provide. We come across good articles in the paper that I think put the right message out. And there was a really nice one recently that you can find on our Google Plus page or our Facebook page. Both of those are American Fidelity Reverse. And we can also mail you a copy. When even wealthy homeowners are using reverse mortgages, the question is, why aren't you? And that's really interesting to see that, wealthy people are starting, what we call the mass affluent, are starting to get it. And then recently there was a booklet put out by Boston College on research about using your home for retirement and how home equity can be that fourth component of your retirement. So we're going to look at our sample test loan here on a reverse line of credit client with a free and clear house. And just, we just made some things up here, Jennifer Reverse on Front Street in Aurora. But this can be anywhere because the loan limits are the same nationally. HUD just maintained the 625.5 max home value limit. And what that means is the maximum home value used for the calculation of a reverse mortgage is $625,500. Once that value is obtained and ascertained, then the calculation becomes based on your age, how much you qualify for. So our person, Jennifer, is 65 years old. Maybe she's not retiring, maybe she's nearing retirement, but at 65, that's one of the first levels where people start to look at and say, I'm gonna look not only at retiring, but 65 and a half, I get somewhat of a better benefit. And we'll talk more in another presentation about how you can use a reverse mortgage to delay your Social Security. So we plugged her information in, we gave her a birthday at 12/10/49, $250,000 home value. And we look at her situation is the 60% utilization says she can have $74,000 at closing. Now this is an area where the sales force, in my opinion, has kind of put the bad image out there for the product because most salespeople try and talk you into taking that whole $74,000 when maybe you don't need it. And the reality is if you don't need the money, don't take it because the main thing you want to use your reverse for is to give you access to the money. And we're going to see the power of what that access does here in a minute. But let's say that maybe she didn't need any money at closing. And so she got herself access to $128,601. And this is assuming some moderate costs. So let's say she's getting out the door for less than $7,000 in closing costs. What are those closing costs comprised of? Well, you see the HUD mortgage insurance has gone down to only 0.5% of the value of the house. So she's only paying $1,250 in mortgage insurance. Now, what is that mortgage insurance is a question that comes up often. And the answer is that insurance guarantees this program. It guarantees the things that we're going to talk about today will happen, are guaranteed to happen and cannot change. It guarantees it stays in full force till your 145th birthday. And it guarantees that there's no recourse on the loan, which means nobody's on the hook for any amount over and above what the home sells for. And we talk a lot about different scenarios of things, but in her example, we're going to say she has $128,000 she has access to. She doesn't need it today. So here she is. We're going to simulate this out, and we're going to base it on the 4.89 that we discussed earlier. And we're going to see what that $128,000 does over 5 years. $128,601 after year one is $136,723. Now you're not earning money, you're gaining access to more money. And in that example, it's about $8,000 because you grew $8,000 that year. It's compounding, so now you're up to $145,000 in year two, and we'll skip to year 5, 3, 4, 5. So 5 years into obtaining her reverse mortgage, Jennifer Reverse has access to $174,676. The unique thing is, it has nothing to do with the home's value. Let's freeze right now the home value at 0 appreciation. But for example, as we've talked about in previous videos, if her home value went down to $150,000, she'd still have access to the $174,000. And so now at 70, she still doesn't need the money. Maybe she worked till 70 and maximized her Social Security and has a nice retirement account that's equal to her line of credit. And so she in reality has $350,000 access. So now we're going to take her to 75, 10 years down the road from when she did her reverse mortgage. So now she started with $128,000. Her line of credit has grown to $237,000. It's almost doubled. Again, that's assuming a 5% average rate over time. The automatic adjustment for inflation is when rates go up, your rate's going to go up. And standard is we do a 1-year fixed with a 2% cap and a 5% lifetime cap. So that's really safe too. What I always tell somebody in Jennifer's position is if you have most of your money on a line of credit, a higher rate of interest wouldn't necessarily be a bad thing because you're getting a higher return on your money. Now you can see her equity reserves. This is really basically all equity. But she has access to $237,000 that she can get in any manner that she wants to. We're going to take her now to 80. So we're going to go 15 years down the road, then we're going to come back and look at a couple more examples. 78, 79, 80. Now, uniquely enough, at 80, she has access to more money than the value of her house. And that is, we cut the appreciation out at one point so that we could show this feature. But no one can stop her from collecting this money. And she can collect it a lot of different ways that can help supplement her income, help improve her retirement. Let's say at 80, like a lot of clients we run into, she's burned through all of her retirement dollars and doesn't want to move out of her house. Well, she doesn't necessarily have to because she could start to draw out a supplemental income amount per month as she chose. And with that kind of access to dollars, she could set up a 10-year program where she could get a couple $1,000s a month for the rest of her life easily. And that would be no matter how long she lived and no matter how much she drew. So that's the advantages, and that's what the mortgage insurance is doing for you. Now, the thing that I always say is, why doesn't everybody do this? Hopefully, there's light bulbs going off amongst everybody watching this video, because right now, she owes about $17,000, $18,000, and she has access to $322,000. Did she make a smart decision at age 65? I think it's safe to say that she really did. And I think if people got this part of it, then people would be calling American Fidelity Mortgage Services and saying, I would like to get a HECM mortgage with an available line of credit because it's going to help secure my retirement and secure my future. So we're going to start over, and we're going to look at this and say, what if she's what if she needs money now? Okay, what if she needs $5,000 at closing, and she needs $800 a month, and she wants it for 10 years? So she's going to have a line of credit of $51,000. She's going to put $5,000 in her pocket, and she's going to get a check for $800 a month the first of every month for the next 10 years or 120 months. And the question would be, then where will she be in 10 years? And the answer is almost back to square one. She'll have access to $95,000, and she will have received her $800 a month, and then she had the $5,000 that she put in the bank to help her feel a little more secure. It always feels better to have some money in the bank. We're going to look at one more example, and that's going to be somebody who has a financial planner who is setting up her reverse mortgage, and is going to use it in a smart manner to supplement their income. Let's say we're still working at 65. We don't really need the money. We draw out $5,000 at closing because we want to do a couple things around the house. It's needed some work, and it's a great source of income. And we were thinking about doing a home equity line of credit. And a home equity line of credit is a very harmful tool, as you can see in our other YouTube videos. So we get to this point, and let's say at 65, she's still working. We don't draw out any money, and we just advance up 3 or 4 years. So we get to 68, and she decides to retire. Now, upon retirement, she discovers that in order to meet her expenses, the biggest problem she has is that her property taxes are about $6,000 a year. And she can live on what she has in Social Security and draw out her money from her retirement. And technically, she's not required to draw out her money until age 70 and a half. So maybe she wants to let that money grow a couple more years. So for 2 years, she draws out her $6,000 to pay her property taxes. She didn't even draw down into her line of credit. She was essentially drawing part of the growth. Now let's assume that she starts to draw in her retirement, and she can draw a couple $1,000s a month based on just interest. Maybe she has $500,000 in a retirement account, and just drawing the interest gives her $2,000 a month in income. So she doesn't need her reverse mortgage. And so she's going to advance up maybe to 74. At 74, she looks at it. She's maybe taking a hit in the stock market. She needs to stop drawing money so she can recoup some of her growth. And she decides, in this down market year, I'm going to live off of my reverse mortgage, and I need $20,000. So she draws out over the period of 12 months $20,000. Well, she didn't draw out $20,000 off of her line of credit because she took a part of the growth and a part of the principal. And let's say, again, the same thing happened, and now her retirement portfolio has come back around, but she still decides that rather than earn additional money by drawing it from her retirement, drawing from my equity turns out to be a really, really smart decision. So she says, you know what, I'm going to supplement my income $12,000 from my reverse mortgage, and I'm going to supplement my income $8,000 from my retirement account. What are you gaining there? You're gaining the fact that your retirement dollars are going to stretch a lot further. You're intelligently using your home equity in an example that's one particular fingerprint, because everybody's mortgage fingerprint is just a little bit different. So that right there gives you a very good snapshot of why everybody who's a senior citizen should be looking at a reverse mortgage instead of some of the other products. As we've talked about before, a reverse mortgage line of credit is a lot safer than a home equity line of credit from a bank. What if a bank gave you a $50,000 line of credit and you couldn't afford to make the payments? You could lose your house. What if a bank gave you a $100,000 line of credit and you felt all secure that you had access to it, and then one day they called you and they cut your line to exactly the amount that you owed them, which is $30,000, and you were using debt to service that debt? Essentially, what a lot of seniors are doing with a home equity line of credit is self-creating a reverse mortgage by negatively amortizing within the loan, using the funds from the loan to make the payment to the home equity line of credit. This way, you can make a payment if you want to, but with the credit line growth rate, the fact that it goes to your 145th birthday, the fact that it's all backed, guaranteed, and insured by the federal government, and they can't cut your line of credit, I believe all those things make this a way better, more intelligent, and smarter determination. So the new reverse mortgage is the way seniors should be looking at going today. Thank you.